Dr. Christensen and I want to start out today with this flow chart, and we want to just maybe explain a little bit of it. We don't have time, obviously, to go through the entire thing, but it is a good flow chart showing the impact on the housing market, the financial market, and then, of course, the government and industry response to all of the problems that we're facing. The subprime mortgage crisis is the root of this financial crisis that we're in right now. A subprime mortgage is created by lending to those individuals with a less than perfect credit history. They have a heightened perceived risk of default. Might be those individuals that have a history of loan delinquency, loan default, those with a recorded bankruptcy, or those with limited debt experience. So maybe you have a little understanding now about what it means when the word subprime is used. Looking at the beginning of our flow chart here, we see that housing inventory is listed, the excess housing inventory. So if we look at housing prices, this is just a slide that shows the median sale price of houses beginning back in 1968. The latest data was through 2004, a 36-year period. We see that there has never been a time when housing prices have declined. They have increased over every single year. And of course, housing is about 10% of our economy, so certainly it has a major impact. Well, with so much going on as housing prices increase, what happens? Well, we get these ideas that prices are going to always go up. They will continue. We've had this long time frame, so it will only continue. That's all it can do. Well, you know, if prices are going to go up, why don't I buy a house? I can stay in it for a little while, and then I can sell it and make a profit, a nice profit. So, you know, that's a very good thing. Let's jump on that bandwagon. Let's try that. Well, I can always refinance. If I get into a situation and I don't like the mortgage I have now, I can always refinance later because the price is always going to go up. My investment is going to have a greater value, so it's going to be worth me keeping it, and I can just refinance. And of course, the easy credit that we've heard about. When individuals that really weren't qualified to get the amount of debt that they were allowed to borrow, maybe they didn't have the complete documentation to prove that they were credit worthy, and lenders in a very competitive market trying to make more loans, and so individuals were caught up in this, and maybe they did make mortgages beyond their ability to repay. With mortgages, also, I could briefly mention, maybe some of you are not familiar with the adjustable rate mortgage, and so in the beginning, you have a lower rate and then it adjusts over time, so your payment doesn't stay the same. It's not like a fixed payment mortgage where you have that same amount every single month for the life of the loan. This could change, and many people weren't aware of that, didn't realize that, expected their income to increase at the same rate, and it didn't. I also mentioned using equity for additional asset purchases. For example, if you think the housing prices will always continue, you have a loan on that property. As the price increases, the value increases, then you have a higher equity stake in that. You can use that to then go borrow and refinance a second mortgage, maybe another first mortgage, refinance. But you have cash. Then you can spend it on something else. You can use that cash to go on vacation. You can use that cash to buy a vehicle, whatever, as long as the value of your home supports the debt that you have on it. And of course, we all probably know that there is a tax write-off. There is the interest amount that we're able to deduct on our tax return. So very beneficial. It didn't stay that way. It didn't work. Housing prices declined. And this slide represents the last 12 months, beginning with August 2007 through 2008, showing what has happened. The prices have declined. The median price on a national basis went down 9.2% over that 12-month period. We see that in the West, that particular area was the hardest hit, close to a 25% decline in prices. So the bubble burst. This is the housing bubble that we've been talking about, we've been hearing about. I wanted to briefly give you some information about the mortgage market, because to understand the financial crisis and the liquidity crisis, you have to understand the secondary mortgage market. The primary mortgage market is what many of us think about. You go to a lender, you're face-to-face across a desk, and you want to borrow money, you want to buy this property. So you negotiate, you work out the deal, and I always say, you sign your life away, you sign that very long-term debt. Well, risky lending practices, as I mentioned earlier, contributed to the bulk of the subprime mortgages that we have, and individuals taking out loans that they didn't have the ability to repay. But also we have to think about the shift of risk, because when those primary mortgages are made, they're then sold in the secondary market. And there's a shift of risk at that point. And so this probably contributed significantly to the problems we have with those subprime mortgages. In the secondary market, we have government-sponsored enterprises such as Fannie Mae and Freddie Mac, and to give you the full name, Federal Home Loan Mortgage Corporation is Freddie Mac, Federal National Mortgage Association is Fannie Mae. These are both sponsored by the government, but they are private corporations. Their purpose is to make liquidity in the market, to make the money available in the mortgage industry so that primary mortgages can be made. So those primary mortgage lenders have liquidity, they have access to cash. So they purchase the mortgages, they pool the mortgages, and then they sell them as mortgage-backed securities. The mortgages are put together and they're sold in a way that they have to have a credit rating, and they go to all different types of investors. Well, you know that there's been some significant problems with these two agencies. The statistics related to 2008, these two agencies, and I say agencies, I should say entities, Fannie Mae and Freddie Mac, guaranteed or owned about half of the U.S.'s $12 trillion mortgage market. So just about every home lender, just about every homeowner has done business with these institutions. On September 27th, the Federal Housing Authority put these two entities under conservatorship, and the U.S. Department of Treasury was contracted to acquire $1 billion in senior preferred stock of both of these organizations. Their losses last year totaled $15 billion. So, the stock that these institutions had issued is not valuable anymore. It is now worthless. So 1/3 of U.S. banks were holding preferred stock that had been issued by Fannie Mae and Freddie Mac. So $36 billion of this value was cleaned out when the federal government took them over. Not only does it have an impact on the U.S., but it's global and worldwide as well. $5 trillion of debt and mortgage-backed securities were issued by Fannie Mae and Freddie Mac that are owned by central banks and other investors worldwide.